Good afternoon, folks, and welcome to our webinar with Suresh Badami. This is the Kings of Capital webinar with Suresh Badami of HDFC Life. Suresh has been an executive director of the company since 2013. He joined the firm 8 years ago. Before that, he was with firms as varied as Dunlop India, ICI, Max Atif, and ICICI Bank. He's been in this the sales side of various industries for 27 years. He's got a BSc from Bangalore University and a MBA, postgraduate diploma in management from the Xavier's Institute of Management, Bhubaneswar. The reason we reached out to Suresh was, as many of you know, Kings of Capital, HDFC Life is one of our positions. In fact, HDFC Life is also in our consistent compounder portfolio and many of our other portfolios. And the reason we've been impressed by this company is over the last 10 years, HDFC Life share in the Indian private sector insurance market. In fact, HDFC Life share in the overall Indian insurance market has grown from 8.7% a decade back to close to 22% now. And I think you might have read in Tej's newsletter on HDFC Life that in an industry where the profit pie has shrunk over the last decade or so, HDFC Life has grown profits at a compounded rate close to 20%. So remarkable firm. Why this company is so successful is what we are basically trying to understand from Suresh, because he's been at the helm of affairs. So Suresh, welcome to our webinar.
Thank you so much, Saurabh, and thanks for having me here. Just a quick edit. I've been with HDFC Life since 2013, but been on the board since 2018.
Right. So sorry about that. And congratulations. I remember the promotion. Congratulations. So just to sort of broadly lay out the sequence of events for everybody, we'll request Suresh to kick off the webinar with some opening remarks on why his company has done so well, and also why there's been an upsurge of interest in life insurance. Post that, there's a few questions that we'll pose to Suresh. Those of you who are watching, if you have questions, please put it in the Q&A box. Don't use the chat box. Put your questions in the Q&A box. We have Suresh till 7 o'clock. And we'll take as many of your questions from the Q&A box and pose it to Suresh. At 7 o'clock, once Suresh leaves, whatever questions you have on Kings of Capital, please present them. Tej will give you a portfolio update as well. And then you can ask Tej questions on the portfolio. So Suresh, over to you. Floor is yours, sir, for your opening remarks.
Right. So thanks again. And very good evening to everybody on call today. I like to start off with something which I'm sure almost everybody is aware and keeps reading in the newspapers. The life insurance industry in India is considered to be fairly underpenetrated. And, over the many years, if you look at the whole background of how life insurance, there's a fair amount of time where LIC used to be the monopoly in some sense in this sector for a fair long period of time. And in 2000 is when all the private life insurers were allowed to come into this particular market. Now, if you were to look at the various distinct phases in which the whole industry has kind of developed, you would find that from the 2000 to the 2006-07 phase, that was the first phase when the private players were expanding, they were increasing the number of branches, there was a huge amount of presence which was there, was one phase where the life insurance industry did pick up in terms of the overall growth. Then around 2007, 2008, when the economic crisis hit, there was a fair amount of turbulence which hit the industry at that period of time. And in 2010, IRDA came out with the new product regulations where a lot of things were changed in terms of what you could charge the customers on ULIP, and many such factors came into place. 2013 saw a fair amount of turbulence again, when some of you may remember when this industry got hit by what was called the Cobra Post, where a lot of tightening was done by the industry in terms of the quality of business that this industry was getting in. And post that, a lot of the insurers have been consolidating the kind of business that they have been doing up till maybe 2017-18. There has been a steady growth in terms of how this industry has grown again and consolidated. In 2017-18 is effectively when the digital or the next phase of insurance has kind of evolved in the country, where a lot of effort has gone in terms of how do we look at digitizing the whole insurance. And 2020 is when COVID hit. So the way I would look at it is this industry post the LIC monopoly for a fair amount of time has seen 4 or 5 distinct phases. You've seen from when the private insurers grew to the 2018 to the 2010 product regulations to the tightening during Cobra post, then the digitization journey, and now probably what has happened in COVID and the post-COVID. Now, if I were to look back at the journey of most of the private insurance players, I think it is important that each of us kind of recognizes the kind of opportunity which exists in India in terms of life insurance. The way we look at the overall industry is that there is a huge opportunity in four areas of risk, right? And insurance is about taking care of risk. The first one is clearly in terms of the mortality, right? In terms of what will happen if people die. Then is in terms of morbidity. What happens is in terms of what we can do in terms of health and health related insurance. Then clearly in terms of longevity, right? Where we look at people who are probably going to live longer. The lifespan in the country is increasing year on year, and people have not really thought through in terms of what kind of investments they need to make, where they will be able to kind of sustain during their retirement years. And fourth, obviously, is the overall interest rate risk, where people are looking at savings products in terms of how do we look at ensuring that we invest in a certain range of insurance products which give you a combination of both savings as well as life cover. Right now, if you were to look at each of these elements, the penetration in the country is fairly low. There has obviously been improvement. The industry has been growing year on year. There have been periods of consolidation during the different phases that I spoke about. But if you were to still look at it, I mean, if you were to look at Swiss Re reports in terms of the protection gap in the country, it still remains as high as 83% in terms of the protection gap. If I were to explain it in very simple terms, if there was a certain expected protection cover that the whole country needs, depending on how many people are working and what is the average working salaries, and based on that, what should be the typical life cover which should be there in the country. And even if you take 50% of the household savings as part of the protection, you will find that in India we are still covered to almost only up to 17%. So 83% is still what we call a protection gap. Similar numbers, if you look at morbidity in terms of health insurance, you will find that 60 to 62% of the money that gets paid towards medical expenses is actually coming out of people's pockets. It's not really getting covered through insurance. If you look at longevity, clearly this is a segment which is not even being quantified, and not many people have understood, what kind of money is required for saving for your retirement years. People have really not gone and kind of assessed the kind of opportunity. There have been a lot of pension and annuity products. India as a country, really, there is not much of a social security net. So it also depends in terms of what kind of savings have people put aside. And things are changing. Lifespan is increasing, medical expenses are increasing, nuclear families are no longer there to support you. So clearly the amount of money that individuals need beyond the age of 60, 70 to take care of themselves is also increasing. On the savings side, of course, there are a plethora of products which people can invest in. I think Saurabh and team clearly are the experts of that. But whether you want to invest in real estate, whether you want to invest in mutual funds, whether you want to invest in gold, whether you want to invest in many other asset classes, you also have an opportunity to invest in life insurance products. So the way we look at it is that, look, there have been different phases through which the insurance industry has kind of evolved. The market opportunity on all areas in which we operate, whether it's mortality, morbidity, longevity, or interest rate risk, is significantly high. And as a country, we remain significantly fairly underpenetrated. If at any time, if you were to look at it, our insurance penetration in a country as a percentage of GDP has been anywhere between 2.7 to 4.2%. And as compared to some of the more evolved markets, even if you were to look at this, the country will continue to kind of give an opportunity in terms of growth. Yes, the sum assured as a percentage of GDP has been increasing. I think that's a good sign for us as a country. But even there, if you were to look at some of the more developed markets, we probably are not fully adequately covered. So again, if you were to dwell one step deeper into how the insurance industry has evolved, and I think it's important for us to see how the overall private life insurance industry has evolved, for us to recognize, one, the opportunity, and two, why as HDFC Life, we have tried to make a difference in this particular industry. Uh, I mean, to be fair, when the initial licenses were given into India, there were a few players who had come in. And over the years, if you see some of the top players who are there amongst the top five, all have had in some sense a bank assurance play, right? And just to explain it a little bit further, insurance, is in some sense still a little bit of a sell product. It's while there are a lot of people where awareness is increasing, there is still a fair gap in terms of how do you make the product available for the customer, convince the customer. And I will touch upon products in some time. But what has happened is over the years, the larger players have been the ones which have been primarily been in the private life space, been with a banker partner. So if you were to look at SBI Life with SBI, if you were to look at ICICI Prudential with ICICI Bank, if you were to look at Max Life with Axis, if you would look at Bajaj and Birla and all of them with Citi and Stancy in the past, and of course we had the relationship with HDFC Bank. Uh, a fair amount of the distribution expansion which happened with the initial large private players has been with the players who have had large banker partners. And that is one area. The other areas of how we can let the insurance product reach out to the customers are clearly in terms of the traditional agency model, which is what LIC has followed over the years. That also depends on what kind of financial consultants, how many financial consultants, how many active financial consultants are in the market. And similarly on the broking side, similarly in terms of direct, and more recently in terms of the online self-source business, which companies look at through the digital medium. Now, all companies have in some sense grown on these traditional models of bank insurance, right? And so have we. We've had the advantage very clearly of having the HDFC brand, right? I think the clear advantage being the parentage to have HDFC Limited. We have had in terms of group companies of HDFC Bank, HDFC Ergo, HDFC MC. I think it's been a fair household name across the segments. So in insurance, as a product, there have obviously been huge difficulties in terms of customers actually going and out there and buying insurance. So a lot of industry has been talking about how do we convert a push product to a pull product. In many ways, there was a time when an LIC, or I must say LIC, but any agent would call you. The first initial idea was to kind of see how you could get out of the phone call because it was supposedly a pitch or a push sale, right? But what has happened, and I do believe over the last 20 years, multiple things have happened. One, awareness of the product has significantly grown, right? And it could be because of the proliferance of many of the private players who have expanded a lot of marketing activities which have happened. There have been initiatives by the government in terms of launching products like PMJJBY, which has taken insurance as a product to various corners of the country. Second, what IRDA has rightfully done is has tried to ensure that the products have become much more transparent and customer friendly, right? So they've tried to ensure that there are clear caps in terms of what charges you can put in ULIP products. They've tried to create in terms of what you can charge to customer, what can be the expense of management guidelines which can be put into place. So the products in some sense have got simpler and more transparent and more beneficial to the customer. And the third aspect, so the first was awareness, the second was better transparency, and the third was the ease of sale, which is what has kind of transpired over the last few years, is in terms of how we are looking at digitization of end-to-end journeys for the customer, rather than asking for a plethora of documents, going back and forth between the customers. A lot of effort has gone in terms of ensuring that we ease the KYC process, we ease the underwriting process, we ease the medical process, and so on till we hit the service levels as well as the claims process. Now, a combination of 4-5 of these factors is what has kind of led to this insurance industry growing at the kind of rate, at least the private players which have been growing and the top private players which have been growing, is the fact that the distribution has been expanding, is the fact that products have become simpler, the awareness has increased. So, we've had this discussion multiple times in terms of, how has HDFC Life kind of differentiated itself and how we believe we have positioned ourselves as a company when it comes to this particular space. So I will share with you in the sense that look, the opportunity is very large, and the opportunity is there for all the players who are there in the market right now. Given our population, given our insurance density, it is very easy to be able to sit across any individual in our country and convince them that they are either not adequately covered in terms of life cover, or in terms of savings, or in terms of the retirement savings that they need to do. So we have, like I mentioned earlier, have had the benefit of actually kind of riding our initial journeys also in terms of how we grew our agency as well as our bank insurance business. But our philosophy has been very, very simple in some sense, right? Our philosophy has to ensure that first we create an outstanding value proposition. So if you were to look at it, we try to make sure that, look, the products that we are coming out with year on year are innovative, year on year make sense for the customer. These are products that each one of us would buy ourselves rather than having to pitch it. So if we come out with a product, and over the years, if you look at what HDFC Life has done, from the initial pension products to the deferred annuity products, to cancer care, to click to invest, to the non-participating products like Sanchay Plus, every year our objective has been to ensure that we come out with products which are a market in itself, which differentiate itself not to just the existing products in the insurance industry, but maybe in some sense allow other asset class products to get shifted into insurance, right? So the whole idea was to ensure that we create a product range which kind of caters to the life cycle, life stage of all our customers at various ticket sizes, right? And we have succeeded significantly in that. Many of our products are leading products in the market. Two, yes, like we mentioned, there's a fair amount of work in terms of a brand awareness, because it is important that people, when they think of insurance, should think of HDFC Life. So our entire Sar Utha Ke Jio campaign, people tend to look at us, and over a period of time, they've understood that these are the best of products coming from the best of companies. Not trying to, but look, that has been our objective. And I know, look, every year it's a journey for us, and that's one of the reasons why we're doing that. The second thing that we have constantly looked at as a very clear strategy is to ensure that in whatever we do, we follow a very balanced product mix, we follow a very balanced distribution mix, right? And a lot of our effort has over the years gone in terms of ensuring that we build this in a very sustained manner. The idea being that there should be nothing which should disrupt us, and we should be able to withstand various business cycles and whatever happens in the external environment. Now, there was a time, frankly, we were very, very dependent on HDFC Bank as a partner. We still have the best of relationships. We still have a partner. But what we realize is, while we will continue to grow with the bank, it is important for us to grow our entire distribution with a whole host of partners who we believe can help us reach out to the customers. So we, in some sense, put a lot of effort to ensure that we expand our bank insurance base. So even as we speak, we have almost 300 partners, almost 275 on the bank and the NBFC side, and many more on the new ecosystem and the digital side, right? The idea was to make sure that we map the country and we look at how do we reach out as an insurance product to every nook and corner. And in Saurabh, in some sense, it will touch upon how do we reach out to the tier 2, tier 3, and how do we reach out. But there was a very focused effort on our side to make sure that while, our main partner bank like HDFC Bank grows, we worked with, so, along with them at that time, we had Ratnakar Bank, we had Saraswat Bank, and few of the partners. But then we went back and said, look, we will grow with many new players who are coming in. And we started working with all banks and NBFCs. So we worked over a period of time. We got both the two new universal banks, HDFC Bank and Bandhan Bank, to work with us. We work even now with almost all the small finance banks, whether it's Ujjivan, Utkarsh, Capital SFB, Equitas, Ujjivan, Suryodaya. So what it allowed us to do was make sure that as the bank increased their presence across various geographies, we went along with them, and we were able to reach out to the customers in terms of being able to provide our insurance products. In parallel, we also believe that, look, the agency channel is something which adds a lot of value. And the agency channel has also evolved over the years in the industry, right? It's never been a very, very high quality profitable. And we have invested a lot in terms of ensuring that we try and onboard financial consultants who are able to add value to their customers in terms of being able to tell them about their financial education products, tell them about which kind of products will suit their benefits, and they are here as a career option. So we started identifying people who are mutual fund distributors, other financial consultants, people who are retired, housewives above a certain age who are looking at this as a career for a long period of time. And slowly we put our processes in place so that we ensured that we built capability in our agency channel. So where we were probably number 8 or number 9 in the agency channel, we kind of ensured that we built our entire agency base. We are now more than 100,000 agents in the country, and we are probably one of the largest non-unit linked agency in our channel with a persistency of as high as 90%, right? And in fact, our overall persistency is very high and it's among the best, which in some sense means that all the customers who have invested it with us have understood the product and are willing to continue with it year on year. And that has been a little bit of a problem in the industry overall when it comes to the agency channel. So what we went back and did was we made sure that we had a balanced product mix, which was between term, between unit link products, between par products, between non-par products, between annuity products, because obviously the segments were large. We had a balanced distribution mix, and which was alongside banca, NBFCs, agency, broking partners, our own direct team, our online system, and some of the other ecosystems that we work with. What really it helped us do was in many ways ensure that, one, we focus on the quality of business. We are able to look at penetration on our retail customer base at a large level. We were able to bring out products which we sold right through the right channel. We were able to build capability the way we wanted it across each of our partners. And to be fair, a lot of our current presence and our current market share is really because of the support and strength of many of our banker partners as well as our financial consultants. We have financial consultants who've been there right from the very beginning. We have banker partnerships where we have clear share, but they understand the ethos of working with HDFC Life. They believe that we invest in the partnership. And I think, over a period of time, a combination of what's happening in the larger ecosystem, the awareness and all of that, along with the fact that our products were available in terms of best in class, and the customer had a choice either to go to our branch or to go to a banker partner branch or to go to our financial consultant or to come to our website and be able to get this end to end. So we did that. What we also realized as the products were improved upon, that finally the whole task of buying a life insurance product was quite complex, right? So and it's not so easy in terms of the customer being able to understand everything and being able to provide everything that is needed for that product. So we invested in technology as a differentiator much early on, right? And we went back and said that, look, we need to really relook and think through the way insurance products are bought and sold. Our first objective being very clearly to make the whole process digital and paperless, right? So we went from actually mapping the entire sales journey, we went and mapped the entire servicing journey, and we went and mapped the entire claims journey and made sure it was end-to-end digital. Right. So, and then we looked at what kind of apps, what kind of links, what kind of 3-click processes, what could we do to make sure that once the customer was interested, he didn't drop out in terms of ensuring that they were looking at a life insurance product. I think over the years, it gave comfort to our partners, it gave comfort to the customers, it gave comfort to a lot of financial consultants who continue to work with us. We saw an improvement in productivity, we saw an improvement on the quality of business. We could make out when, whether there was fraud coming into the system, and it helped us build our business. And sort of, just to share with everyone, I think, look, as you grow larger, you bring scale, you're able to invest further into your products, you're able to invest further into your technology, you're able to invest further into your distribution, right? And I keep telling this to my team that, look, finally, if we keep growing and, you have 100 rupees to spend, and as you keep growing, maybe that kitty increases. And we need to keep thinking through whether, you want to ensure that some products are cheaper for the customer, some products are better IRR for the customer, then, how do we work in investing in technology? And in some sense, it compounds over a period of time. So we've seen this work for us. Frankly, I must tell you that, look, it is something that we work on daily. There are various forums in which we keep debating how we invest in technology, how we can improve our products, how do we improve our service level, how do we make claims insta, right? In the sense that how can that experience be best in class? Um, as an industry, we have a long way to go. Even as HDFC Life, we believe that look, there's a lot more that we can do, but the opportunity is there, and that has probably been our journey in terms of looking at the overall market, the segmentation, our distribution, our product range, and thanks to, I guess, a lot of people who have been involved with HDFC Life over the many years, our partners here, we are where we are right now.
Awesome. That was fantastic, Suresh. That was riveting, actually. So I'll pose two questions for you, and I'll request Tej to take the first question that he wants from the Q&A box and pose it to you. I'll pose two questions which are sort of interrelated, Suresh. It's on the technology theme, right? So you've been at the forefront of leading HDFC Life's foray as you guys have conquered the market. There are two different aspects of HDFC Life's technology that Tej keeps highlighting in our internal meetings. The first is how your firm has used technology more cleverly. We think more cleverly than your rivals on the underwriting front, because your underwriting profits seem to be consistently superior to that of your rivals. So, would love to understand how exactly has that happened? Because at least prima facie a decade back, I used to think कि सारे लाइफ इंश्योरर्स के पास सेम डेटा है everybody is using that LIC mortality table. Everybody has the same reserve of data. So how exactly have you guys been able to use technology to pull away from your rivals on the underwriting profits front? That's the first question on technology. I'll follow up with another question on technology. But if you don't mind helping us, give us some insight कि आपने क्या किया underwriting front पे.
So, frankly, Saurabh, I mean, I'll touch upon another key point which in this journey on technology and how it helped us before I come on to the underwriting. I think the last phase of what probably has impacted the life insurance industry has primarily been the whole COVID wave, which has come and hit, right? And if you look at how COVID has kind of impacted the overall industry over the last 2 years also, I think it's important we address that. And, a lot of our investments in technology since 2013 and how it helped us. It's not that we invested in technology and the whole shift to life insurance in COVID happened because of COVID. While it has definitely accelerated the pace at which COVID started working. But like I mentioned, the idea was to make sure that the best of products were available since the awareness was there, and make sure we deliver them in a seamless manner through technology to all our partners, right? So when COVID kind of hit us in March of 2020, a lot of people, while they had technology in place, probably didn't have the capability and the BCP process in place to get this technology in place. So even before COVID had come in, I think a lot of our investments in technology on the basic processes, whether it was servicing, right? They were 24/7, you could access them. Our whole backend processes were mapped end to end in terms of technology. Even our sales processes, right from how we generated a quote to how we filled in the form to how we did pre-verification calling, all of that had kind of turned digital through taps. A lot of players had done it, but it had actually kind of become core to the sense that we really didn't have paper on the ground. So, the initial impact of COVID actually hit everybody, and the industry, if you were to look at it, because March was a very high month, got impacted. So while the industry grew at 6% that year, we 6 or 8%, we grew at 19%, right? Even the year from April onwards, when the whole industry was kind of struggling with how to take care of, because at that time there was complete lockdown. There were employees who we ourselves were saying, don't go out of your house. Many of our financial consultants were the older profile, where we didn't want them to go out given the risks of COVID. A lot of our investments in technology in the process where we could do entire remote end-to-end sourcing, right? We could do upsell, cross-sell, where we could make sure that gave us a little bit of an impetus over April, May, June, July. I mean, April, May, June were obviously dull months for us. And a lot of people came to us and saying, oh, look, now there's the pandemic, there is so much awareness, and life insurance industry is obviously going to do well. Probably not truly the case, because while term and health clearly had a huge awareness and demand in the market, there were a few things that we needed to look at, right? One clearly was that there is a savings element to it. People were not sure about their jobs. People were not sure about their business is doing well. So the savings which gives the bulk of the volumes went slow down. While there was term, you needed to be careful on term. When there is a pandemic coming, you have to be very careful in terms of who you're sourcing. Three, operationally, it was very difficult because your employees were not going out, customers were not meeting, and obviously, when you want to give and get a medical done, nobody was going to the hospitals, right? That is where we believe that a lot of the technology elements that we had put into place came in to help for us, and we were kind of able to streamline and through the year we again grew at some 17-19% as compared to what the industry grew at 8%. So if you were to really look at HDFC Life, I would say a combination of our products and a combination of our technology is what helped us grow at like 17 to 19% over the last 2 years, whereas the industry has been growing in anywhere between the 6 to 3% kind of a range. Right. So now when it came to the other aspect of technology, which in terms of the underwriting, in terms of what we're doing, again, the objective as an insurance company is not just to ensure that we are making it easier for the customer to get life insurance products. The idea is also to understand we have the right product for the right person. So there's been a fair amount of effort over the years in terms of building propensity models and analytical engines in terms of understanding what is the right fit customer, what is he most likely expected to pick up, and who's the right customer when it comes to ensuring that we are taking the right kind of risk and what we are doing, right? So what has happened is we've kind of built on internal what we call PASA models, pre-approved sum assured kind of models, where we are able to go back based on surrogates, based on past trends, based on customer profiling, have a look at who are the customers where we will be able to take a risk based on certain medicals, or lower medicals, who will be able to offer pre-approved products as such. And it has led us to build models, and we have a fairly strong in-house analytics team which looks at building RAG models, whether it's in terms of claims, whether it's in terms of persistency, where we are able to identify cohorts and then able to identify based on persona to say, oh, no, look, you need to be a little bit of careful here. Either you need to rate up, or you need to ask for higher medicals, or you need to decline, and stuff like that, right? And that over a period of time has built into models, which has in some sense helped us. And we were the early movers, and we have probably gone through the protection cycle much more than many of the other players. We were there. So our understanding, we believe, on the protection has been high. Obviously, something like a COVID can come and disrupt almost everybody in the industry, saw a fair amount of it because of COVID. But we do believe that, look, we understood, and a lot of the customers who we would say we have said no to earlier and not brought them on books, based on medicals and stuff like that, which has come into place. There's a fair amount of investment in terms of the whole underwriting models, in terms of how do we build capability. Even during this COVID period, we've kind of moved the entire underwriters from remote, from home, from work. So none of those models. We've looked at where non-medical limits need to be enhanced. We've looked at what kind of pricing needs to be done in certain cohorts. And all those elements have come together for us to make sure. The second element, which I will share with you, is there's a fair amount of distribution strategy in terms of who sells what product, right? And as an organization, we are very clear that each of our channels have to be standalone profitable, right? So obviously the customer out there can go and buy a unit link, he can go and buy a traditional product, he can go in. So we advise him accordingly, but there are certain products we believe is right for the customer, which is what we allow certain channels to sell. So for instance, with agency, while we understand and the customer can go out and buy a unit link, there are only a certain cohort of our financial consultants who we allow to get unit link products, because in the past we've seen very, very low persistency on some of these products. Right. So we have looked at vintage, we have looked at quality, we have looked at past customer behavior, all of that, and built it like a modeling around who can sell, what they can sell, and what we should be putting onto their products. Still some journey to go. Of course, we've been helped by the reinsurers. We've helped, we worked on many of these fronts, and the journey will continue. So in some sense, we have ensured that each of our channels maintains healthy margins. Each of our channels is profitable. Each of the segments that we are looking is profitable, and that's what we continue to do in terms of building the underwriting models.
My last question before we hand over to Tej is on this point. So this under-penetration opportunity, you have it, your rivals also have it, right? Broad access to banca channel, agency channel, your rivals also have it, right? And yet, basis the data that we get, both in terms of top line growth and in terms of bottom line growth, you guys are consistently able to outgun the competition, right? So from outside in, basis the work our team has done, part of it is superior underwriting, which you discussed. But part of it does seem to be that you, as the man leading the whole sales effort, you're being able to somehow prioritize the sales effort in a more focused way. You're somehow being able to figure out where the juiciest spots of India are, whether it's from a demographic perspective, geographic perspective, small town, etc. How is technology helping you do that? Because it's a massive country, massive opportunity. There's only so many hours in the day. How is technology helping you prioritize which are the lowest hanging fruits to go for in this vast country?
So, so there are two parts to it. One, the way our products are designed, the way our filters are put in terms of what we can source, what medical and who we want to source. I think that itself gets led in terms of the design element itself. The products are designed well, the filters are put into place, the
So
capability.
what you mean is something like Sanchay Plus. A
Yeah.
lot of thought goes into, a lot of technology goes into designing Sanchay Plus.
So a lot of effort goes in terms of what will be the product, whether we'll be able to aid it, which product will work in the market, a fair amount of research in terms of what will appeal to the customer. Is there a segment that we have identified? Will a click to invest with low appeal to the mutual fund distributor? Would a Sanchay Plus as a product appeal to the customer where he's looking at long-term guaranteed returns to come into place? How will we be able to support it? Similarly, in terms of cancer care, is there a segment which is there in place? What kind of riders will help attach onto which kind of products in place? So, we have a very strong product committee. We have a very strong product council. That is one which we clearly put into place. So the products are designed in a manner, and we look at pricing, we look at this, which is affordable, which will make us competitive, and we are able to go into the market. So, I will give credit to our product and actuarial team. We are one of the few companies where our product team actually sits under the actuarial team, and where we are able to sit in. And there's a fair amount of coordination between the sales team, the field teams, as well as the product and actuarial team in terms of, and the market research team, to come back and say, look, these are the kind of products which will help us sell and which we want to put into place, and they design something new. That is one. The second piece, of course, is in terms of how do we reach out to all these places and which are the juicy spots. I think we spend a lot of time and effort with our partners in terms of syncing our strategy with our partner strategy, understanding which profile, where they want to head, how do we integrate, who should we be looking at, what kind of customer profile, the right products. So, we have built suitability. So somebody like an HDFC Bank and many of our partners, we have our CRM integrated, we have suitability metrics built into that platform, we have high levels of check in terms of whether the products have been sold right, all that into place. So we know that it's a good quality business coming in, the customer is going to be happy and probably come in later for an upsell or a cross sell. So there's a huge amount of data integration or tech integration that we have done with our partners, right, which clearly helps us. So at one side, we are able to work on technology integration with partners who could be working in, either with Capital SOB, or we could work with Bandhan, which is reaching out to various pockets of the segment. So there is a cut that we look at by geography. There is a cut that we look at by partners. There is a cut that we look at in terms of products, right? And we try and make sure that, are we getting this part right? So, I'm not saying, look, everything right. There's a lot of experimentation which happens at our end. And we understand that, look, we need to ensure the overall portfolio is good. But there is clearly a lot of things that we work with. So, for instance, we decided that, for instance, with Tier 2, Tier 3, we came out with a product with Airtel, for instance, right? And that was part of a bundled product on the prepaid, which came in. Huge number of, sales and lower ticket size kind of products, but which helped us reach out to Tier 2 and Tier 3 kind of products. We kind of slowed it down because of COVID. And, many of these have to be very clearly tactical. You need when to invest, when to grow high, and you need to know when you want to withdraw and when you want to slow down on certain segments, right? And finally, we are in the business of managing risk. And the whole idea was to make sure that, look, we are able to, like you said, get the right spots, put our energy behind the right kind of products in the right markets with the right partners, right? So there is, in terms of a full sales management process, there is a very, very detailed rigor that we run, which looks at by channel, by product. Anything which goes out of line, we come back and say, look, is there something that we need to correct? Is there something that we need to invest? Is there a training capability that we need to build, right? Is there a product that we need to tweak? And that is an ongoing exercise, and everybody in our team is involved, whether it's a technology team looking at it, whether it's the operational team looking at the risk and underwriting, whether it's the actuarial team looking at the product. We have a rigor of a monthly business review, which we keep going back. There is an outlier review, which we keep checking to say, is there anything that we are slipping on? Finally, it's a combination of all of this. I will not give credit to only getting the distribution. I think it's a very clear thought process to say how do you run. And insurance is a single monoline product. It's very complex when you come in inside, but it's very easy for the core team to kind of continuously review each one of them and say, look, where do you want to invest? Where do you want to build? I think where in some sense we have succeeded, frankly, and that's again in insurance, frankly, the products can get replicated very quickly. It's not very tough for somebody to come in with a repeat product. I think the idea is to be a little ahead of the curve, to anticipate, what your partners are driving, where we believe work will happen. And like I said, the whole idea is to make sure that you have a very balanced and diversified mix. And I'll give you an example of this. The very fact that we have a very large bank assurance business, we have a very large agency business, we have a very large broking and direct business, coupled with the fact that we are very strong in, we have a presence in unit link, track, non-par and par, help it out at various stages in our process. So, when open architecture came in, like for instance, and we knew that we were getting ready for open architecture, we knew banks would come in, other players would come in and play. What it allowed us to do was, when that was settling in, our agency and our broking and many of the other channels were getting scaled up very massive. So overall, we continued good quality growth and managed to outpace the industry, right? In COVID, for instance, in the first few months, when our agents and our broking partners were lagging behind, obviously because they were not able to meet face-to-face to customers, and banks were open as essential services, we were able to scale up the banking, and we were able to ensure that the growth on the banker partner in some sense made up for the slow growth on the agency side. So in many ways, at a longer level, it's a strategic thought process to say that, look, how do we have a diversified distribution mix, which will help us take the ups and downs in the environment and also help us build quality business and quality growth. The second piece also is, of course, to ensure that we have a product mix so that we ensure that we're looking at any moment of time. If, for instance, tomorrow term is slightly varied, and we want to go slow on term, how do we go back and build the annuity business? So there is a complete separate team which is looking at annuity and retirement as a segment that's very, very large in our country. I don't think people have even understood, even on this call, I'm sure there will be a lot of HNI clients. I'm sure a lot of individually have to think through on, what kind of annuity products and long-term savings products which can be available. And insurance has fantastic solutions which can cater to that, right? Even a simple product like term, a lot of us feel that we are adequately covered. But, whether you want to look at term in which form or manner till what cover, whether you want to look at it as legacy planning. If you're an SME customer, would you want to look at MWPA as a, safeguard against your business? There are so many opportunities like this, which we believe are possible if you have the right customer, segment and be able to reach out to them. So what you're saying is, it's not that it's just that we've been able to choose the juicy spot. I think we probably have seen the opportunity. So when Credit Life, for instance, when we came in, and Credit Life as a business, which is really the wraparound around the loan. So if something happens to you, your loan is taken care of, right? We work with almost all the banks and the NBFC partners to make sure that all their loans are adequately covered, right? And we saw value in that, and it increased significantly number of people that we covered as well as the policy. But now that a lot more entrants are coming in, that business is getting competitive, a lot of people are coming in. Now we have reached the stage where, yes, we are there, we are the major player, but a lot of those partners who work with us are now becoming our corporate agents. So the retail business is starting from many of those partners as you go forward. So, it's the opportunity is there. Is you have to be slightly ahead. There are, of course, we watch what is the best practice in the market. I'm not saying, I think there are a lot of good players out there. Each one of them has their strengths. We constantly benchmark ourselves to say who's looking at what market, even what LIC is doing, what the other top players are doing. And we then kind of adjust course. We stay true to our strategy, but it is always good to watch, what are the juicy segments and where is it that you can go out and probably gain market share and maintain quality and profitability. I think that threefold focus, we are not hungry for market share. We don't ever say that we want to be number one on market share. It just happens that we are on market share, but we want to be best in terms of persistency, lowest on complaints. We want to be one of the best in terms of margins and profitability also. And that's broadly the three tenets that we run with.
This is just riveting. So, folks, if you're watching and if you heard us and before, if you've read what we have written, this sort of digital dominance is what we look for. So we've discussed repeatedly in the context of NBFCs. Tej has written eloquently about how Bajaj Finance has built utter dominance on the data front on the NBFC side, both data in terms of underwriting and, as Suresh explained, data in terms of distribution. Similarly, ILOM and the general insurance piece and HDFC Life and the life insurance piece. If you want to understand more about why this type of business model, utterly grounded in digital technology and data, why this type of business model is going to win in industry after industry, there's an outstanding book which came out last year called Competing in the Age of AI. Competing in the Age of AI, Karim Lakhani and Marco Iancetti. The examples are American. The examples are American, but Suresh Badami just gave you an Indian example of how a smart Indian company competes, excels, and wins in the age of digital, in the age of AI. Thanks, Suresh. That was riveting. Maza aa gaya. Tej, over to you.
There are a couple of questions around the recent acquisition. If you could cover off the rationale for the recent acquisition.
Yeah, I guess this is more topical and it's there in the press. I think, we kind of covered it in our press release and Vivas also adequately covered about it. Look, let me tell you this. I think it sinks in with the strategy which I've been saying this in the last 45 minutes also. Our idea is to make sure that we have a fairly diversified distribution. We are present in various markets. We are present across various channels, right? We are a very large banker partner, but it has been a very stated objective for us to be a large proprietary channel also. Look, because bank assurance in many of these, while we have our strengths, we have great relationships, it is competitive, but the retail granular agency business to be grown is always something that you need as a balanced distribution mix. Now, Exide as a company obviously has a very large agency business. They don't have very large banker partners. They built it over a period of time. Our team has assessed their quality of the back book. They've looked at the distribution strength that they've had. And advantage is that they're fairly complementary because they're present in the South markets, where we are maybe slightly lower on a market share, not very low, but they're slightly lower on market share, and they help us build the agency channel. One of the things which, Saurabh, I didn't mention because we're short on time, is over the last 5-6 years, as a company, we have invested significantly on our agency business in terms of our processes, in terms of the quality of business, in terms of onboarding new financial consultants, in terms of training, activation, product sale. We believe we have a really solid capability, and we have seen how our agency business has grown up the ranks in the industry, as well in terms of the profitability, and we are number one in terms of persistency in many of those businesses. For us, it is imperative that we continue to build, and Exide in many ways brought us the whole agency channel in terms of a market and in terms of an active vintage team which was in place, right? I mean, there are many aspects to this. Obviously, you would want to look at the quality of back book. You would want to look at the valuation. You would want to look at the distribution that the whole piece comes into place. There have not been any more life insurance mergers or acquisitions. We tried one which got stuck regulatory a few years back. That would also have been good. But the fact is, you need to get scale. You need to build your strengths, and we are very comfortable to know that, look, we will be able to kind of build a business which we are very, very comfortable with. Retail is something that we understand, and we would want to demonstrate that. It's always hard work. It's not easy for anybody to come in and build agency. If you look at even the larger players in the agency business, if you look at the number of active agents, if you look at the agent business, it's been kind of stagnant for many years. Even LIC, in some sense, over the last 1.5 years, has grown its agent base, but it's not really grown. It's always stayed at that 20 lakh kind of a 2021 kind of a lakh. So that was one. Second, of course, is we like the culture, we like the ethos, we like the quality of book that they built, the fact that they're in the South market. So there were many pieces, nothing new in what we have not stated. I think there was a fair amount of comfort. It was obviously it was 100%. It came on to us. I think we realized that we need to expand and grow. We can grow organically, but in some sense, it took us way forward on what we believe was our core strategic area. And I mean, not just this. I think our idea is to grow our proprietary, whether it's a direct or online, and this along in line. It will continue to grow. Look, we will try and grow everywhere. I mean, you may see this here, but even with bank assurance, frankly, while we continue to grow our proprietary business, the bank assurance continues to grow fast because some of our partners are growing fast, right? Last year we acquired, we partnered with Yes Bank as a partner. They are coming in with All India. We've gone live with Utkarsh and Equitas in terms of the pan-India bancassurance business. We have recently onboarded South Indian Bank as our partner. We have ICICI Securities who has come on board as our partner on the bancassurance business, right? So the idea is that we will participate with people who are able to bring financial consultancy, look at life insurance products and do. And the country is large enough for us to kind of work with our partners and grow this. So, we did feel, we saw very clear value in terms of what we could do and how we could grow this business. And I think anyway, I guess Vivas and many of our articles are out there in the press to say that, look, we believe it'll add value. And, some of these things are clearly long run, and we will make sure that we are able to turn it around fairly quickly.
Okay. So I'll ask you a question, Suresh, which I've been actually meaning to ask for many, many months now. So Sanchay Plus has been a blockbuster product, right? Forget about other life insurers. Even some of Marcellus's distributors tell us, some of our largest distributors tell us that basically they're offering to their clients is equities loge to Marcellus consistent compounder socho, and if you don't want to take market risk, aap Sanchay Plus socho, right? It's been an astonishing product to see a life insurance product being sold alongside a equity product, but it's a tribute to how you guys have designed it. Now the question that Samir Arora asks is, how does HDFC manage to guarantee 6.2 to 6.5% return in Sanchay Plus for such a long period of time, 30, 40 years, when nobody really knows what the interest rates are going to be 3 years from now, let alone 30 years from now?
So, Saurabh, we've covered this, and I think we've had analyst meets which have been dedicated to this over the past few years. I think, look, there clearly is a base underlying long-term government securities. There are FRAs in place. There is a very clear model based on which we have ensured that we have underlying which kind of ensures that we are able to guarantee these products. We have been in many ways aided by the credit life business that we have done in terms of ALM matching. And you can be rest assured there's a huge amount of due diligence that we do in terms of bringing the products in the market, other than the fact that there is IRDA. In this particular case, we had also got an external assessment done in terms of the whole product and the synergies. We've had a risk committee had a look at it. We've had multiple aspects for it, but I can rest assured that, look, between our product team, our actuarial team, our finance team, as well as the risk assessment team, we have done a fair bit of understanding in terms of how are we ensuring that we have the base underlying to be able to offer this. We've had to tweak our rates also off and on as how the markets have changed and what's available in the market. You will find that now a lot of other players have come into the market. In fact, many players have come in and kind of copied this Sanchay Plus kind of a product now. So yes, there is a market there, and I can also assure you, like I said, that look, we are very careful in terms of how much business we do and how much we can do. So and there was a time when we launched this product that really went high, and then we said, look, we will bring this down and correct it as we go forward. And by the end of the year, we had brought it back to a balanced product mix. So now, if you look at it, we have a Sanchay Plus on the product side, we have a Sanchay Par on the Par side, we have back to the unit link, we have the annuity products which are coming into place. And our idea is to make sure that we continue to balance this. We don't want to be suddenly 80% in unit linked also. Look, there are the issues if you are going skewed towards unit linked also. So we've kind of built this product based on very, very clear, there are long-term securities which are backing each one of them. There are FRAs that we picked up. There are other ALM modeling that has been done. And we can explain it at length. I think our IR team is always available. In fact, when we launched this product, the first 2 quarters, the whole analyst calls are just around this in terms of how do we manage to offer a product like this. Right. But you can be rest assured we are very careful on our margins and what kind of guarantees we want to do.
And I'll just use this sort of to emphasize to a lot of people in our country get very excited on fintech. Dunia bhar mein, nowhere in the world has innovative fintech been able to survive in life insurance, because as I think Suresh has explained eloquently in the last hour, to survive, to thrive in life insurance, you need massive amounts of data. If you're a new entrant, aapke paas data nahi ho sakta. By definition, you have no background. In a country like ours, if you don't have data, you've got no idea what you're underwriting. Secondly, in life insurance, not only do you need data, you need extremely high quality risk analysis and actuarial science. The whole of India in a given year produces, I think, 100 actuaries. And I think HDFC Life alone, I think, probably would be having some of the best actuaries in the team to access the data, to access actuarial scientists on the sort of scale that these guys are doing will be beyond fintechs in any country. I stress again, you will not find life insurance इंडस्ट्री में फिनटेक्स एनीवेयर इन द वर्ल्ड, उनकी बस की बात नहीं है, डेटा नहीं है, एक्चुअल साइंस नहीं है, एंड फाइनली you need to have distribution. You need Suresh Badami to get you those 300, 350 channel partners that he's talking about. An HDFC bank or an ICICI bank or a State Bank of India, the massive distribution channels are not going to entertain fintechs. So you could have fintech in general insurance. Unfortunately, that also has been put to rest by some of the decisions that our courts have taken, which has made it almost impossible for fintech to survive in the auto insurance space. So the only area really in India where fintech could have a bit of a run is health insurance and home and contents. In a way, home and contents is probably the only area where a fintech could have a bit of a play. So I know people in our country are getting very excited about fintechs, but life insurance, it doesn't work. Tej, over to you.
Sorry, it's not that, Saurabh, that it's not that we would not be interested in looking at fintech. I think, look, we have as a strategy ensured that we invest in technology and we try and develop ourselves internally. I think there is a team which is constantly looking at how do we look at fintech and how do we look at how partnering with fintechs, which will give us the edge, right? We are always aware of the fact that there can always be somebody who can come and disrupt the game. And it's better that we look at it ourselves first and see how we can disrupt. We had kind of invested into a fairly large tech team, which we in-house placed, which was looking at what kind of technology solutions can be brought in, right? And a lot of our customer-facing applications, a lot of our partner-led integrations have been built by this in-house team, which we call AdCat. So there is a fair amount of work. I think there is tremendous scope to partner with some of these players where they can add value to us. So I think the future would be in terms of how do we partner with fintechs, which give us the leading edge. And we will want to definitely watch the space. We have a separate emerging ecosystem space. We work with System, we work with Airtel, we work with many of these fintech players also. And I do believe that, look, some of these things will evolve, may not be overnight, but we will definitely want to make sure that we understand and partner along with.
Right. Tej?
There is a question from Parikshit around, we've been speaking about balanced product mix and it's worked out really well for HDFC Life over the years. How were you able to, avoid the lure of being a ULIPs heavy sort of life insurer where many larger private sector players are heading towards, and make life insurance more about risk-based product rather than an investment-based product?
No, like I said, look, the market is out there. If you want to sell 100 of unit link, you can sell 100 of unit link. You want to sell 100 of par, you can sell 100 of par, 100 non-par. Look, the question is what product at what interest rates and what margins and what you want to go out into the market. Right. So the way you price your products, the way you push your distribution, the way you incentivize your distribution, how you build capability on the ground, how you assess, each of these need to be in some ways micro monitored and made sure that we reach out to the customer. The customer, if he wants a ULIP, can always go out and buy it from one of our competition or can go and buy a mutual fund product if he wants to look at that rather than coming into unit link, right? Now, the way we have gone about building it is made sure that so there are partners where we have had 60% unit link. There have been partners who are 80% on traditional, on the bank assurance side, right? Our agency channel 6-7 years back used to have a fair amount of unit link. What we realized was that the quality of the business, the persistency of the business was very, very low, right? So we went back and started saying that, okay, look, you will have these products, you will sell these. This is where we build capability. Then we were able to convince customer on par and non-par and, a term kind of product. So what ended up happening was it's not that we have look, our first objective is to get the product right for the customer. You have to get that right. The second is to make sure that the channel which is selling it is fine. Then as a combination of various channels, like I was, Saurabh was mentioning, we keep doing it at the back end to say, okay, look, now we need to push or we need to look at this capability building, build, and we need these kind of partners. And so, whether it's in terms of incentivizing your team or whether it is in terms of telling that these are the customers that you want to go to or pushing analytics to say that, look, these are the customers where par and non-par kind of products have to be sold. I think we've managed that. It has to be monitored closely. It's not that unit link cannot be sold more, but like I mentioned, we also didn't want to sell non-par beyond the point, right? Because the market is there, the product is there. We also wanted to make sure it remains balanced, so that at any moment of time we have complete control in terms of what kind of portfolio that we are building over a period of time. different people have different strategies. Unit linked at a certain scale, I mean, not to say anything about anyone else's strategy, but you will find that a lot of people are course correcting and now moving to a balanced product mix, right? But you need real significant scale to get unit linked. A unit linked product will not break even till you have the 6th or 7th year kind of persistency payout which has come into place, because there are so many charges which are restricted unit link. Any unit link product won't break even till the 6th or 7th year, and if it doesn't, then you're making a loss, right? So which is why you have to monitor it very closely.
So Suresh, last question from us before we let you go, and thank you for the incredible insights you've given us. And I think I speak for many of our clients. So a whole generation of people like me have bought LIC products, then belatedly done some maths and figured out this doesn't make any sense, and then convinced ourselves that the best way to look after our future is buy a term life product, and then invest in Marcellus's Marcellus-like equity products to build your corpus, right? Because जो blended था उसमें difficult experience रहा, and therefore we have unbundled it, term life से protection लाओ and invest in high quality equity products to get the upside. Now, I'm sure you guys have thought about this subject 20 times more than we have thought. To people like me on this call, what would your suggestion be?
So, Saurabh, I've been in banking for a longer period than I've probably been in insurance. So, I've looked at all products on the assets as well as the liabilities and wealth management space. So, this clearly is a question to say that, look, can the customer out there be able to manage with a term and a certain, SIP portfolio and a STP portfolio on mutual funds, and then invest in equity and PMS and stuff like that and manage it. So look, there are 2-3 things the way I look at it. One, of course, is that there are a variety of solutions for life insurance products which add significant value to you, which you should be able to do, whether it's in terms of, like I said, wealth protection, whether it's in terms of saving, there is tax advantages in certain things, there is legacy planning that you can get through, there is business security that you can put into place. So there are a fair amount of solutions that you can put into place. The difference again is that, look, in many ways, life insurance is a long-term product, right? It brings about a fairly disciplined savings approach, which normally you will find that the mass customer doesn't do. Term mutual funds will go up and down. Life insurance, you will find that it's a longer-term product. People stay invested. People stay. It's not that you want to build a house, you sell off a certain portfolio, and the problem that people don't keep their certain portfolios and then you just get rid of one portfolio, which was what was compounding and giving you the wealth. Life insurance does bring that disciplined approach into place, in terms of saving. Yeah, I mean, a very, very evolved customer who has able to monitor, get all this right, maybe can do what you are looking at. But there are certain solutions, there are like a Sanchay Plus and a Sanchay Par, which compete very actively with certain other products which you will be able to look at and put it into place. Right? So I think if you were to look at your entire life cycle, life state, depending on if you're a 30-year-old HNI customer and I'm assuming that I'm speaking to the HNI segment, then if you're looking at a 30, at a 45 years, at a 60 years, there will be a certain portfolio of life insurance products which will make imminent sense, despite you having you need to have a certain term cover. But beyond a certain term, with certain wealth that you've got, you can only use it for legacy plan, right? And you need to look at how do we invest on some of these products. So on a guaranteed side, we are also not saying move everything to life insurance, right? So finally, wealth creation happens by good financial allocation, right? And you need to have certain products of all classes in your portfolio mix. And there are certain products like Sanchay Plus. There are certain products like the deferred annuity kind of a product, which clearly is something which even the evolved HNI customer should look at. The SME customer should look at in the BPA, right? There are a combination of these products which you should look at, which can kind of ensure that something happens to you, your business. And it's a very I learned this way in earlier, and I used to say, well, this guy's got so much wealth, why would he need a term product? And this was one initial call I had gone to Saurabh. And frankly, the person had a business and one son and one daughter. And I think the daughter wanted to get into the business and the son didn't want to get into the business. And at the time, he didn't want to leave to say this will be split and disrupt the business. So they kind of took a legacy planning kind of product where the term was given to the son who didn't want the business, and the business went to the girl. So there's a fair amount of financial solution planning in something like this. Right. So in some broad sense, this question is always an open question, will be asked 5 years, 10 years later also. The disciplined saving, the solutioning that some of these life insurance products can do. Some of these new age products like Click to Invest or Click to Wealth, which are low interest rate and low charges kind of products, which are there in the market, compete as actively with many other products. So, somehow people just seem to associate to say, I don't understand this. Products are much simpler. You have to understand, get somebody to help you out with it, and you can do a very, very good life insurance portfolio also built.
Thank you very much, Suresh. That was riveting. Thank you for your insights, and thanks especially for awakening us to the fact that beyond term life and beyond traditional life, there's a whole range of things that you and your firm are bringing to the market. Congratulations for the stellar job that you folks have done over the last decade or so. And at this juncture, I'll take Suresh Badami's leave, thank him, and request stage 2.
So thank you so much. Thank you so much, Saurabh, and to you and your team and your team, which is investing in us. I think we hopefully will stand by that and continue to deliver. Thank you so much.
A privilege. Thank you. Thanks, Suresh.
Thank you.
Page over to you for the portfolio update.
So we've written about this in our previous newsletter. Would like to further clarify on how a high quality lender operates and how it's been able to convert equity into high amounts of profitability, which results into book value per share compounding and therefore share price compounding for investors. So if you were to look at the lender's balance sheet, it starts with equity on top of the equity which a lender has raised. It is able to leverage anywhere between 5, 6, 7 to 10, 12 times, depending on the type of lender it is, whether it is an NBFC, whether it is a bank. And if we were to take examples based on numbers, the chart on the right shows that if you start with 100 rupees of equity capital, you're able to leverage that, say, conservatively 5 to 6 times. Then your total capital employed as a lender becomes 600 rupees plus 100 rupees. That's 700 rupees. Typical high quality lender can generate maybe around 3% return on asset. So 3% of 700 rupees would be 21 rupees of profitability. This translates into about 20-21% return on equity. So a 3% ROA, which is 21 rupees in terms of profits. If you divide that 21 rupees by the 100 rupees of equity, that's about 20-21% return on equity. Now, assuming that a lender pays out 10% of this as dividends, we left still with about 19 rupees, which can be reinvested back into the business. Now, this 19 rupees goes back to the reserves and surplus of the lender. That amount is again used to raise further leverage, assuming that the leverage remains the same, which is about 6x. This is again a conservative assumption. What usually happens is over a period of time, as a lender does well year after year, it is able to sweat its equity more and more. However, assuming that again it is able to retain a 6x leverage, the capital employed itself increases by about 19-20%. This is because the equity has increased. On top of that, again, you're taking a 6x leverage. So instead of the capital employed amount being 700, as was the case in year 1, the year 2 capital employed for the lender becomes about 830 rupees. Now, again, on top of that, the lender earns the same similar ROA as the previous year, which is around 3%. You get to 25 rupees of profitability. So the jump in profitability is from 21 rupees to 25 rupees. That's again a sort of 20% jump. And again, on top of that, the 10% dividend payout comes through. And this is sort of a virtuous cycle. Even if you assume that the leverage does not increase from 6x, because lenders are able to reinvest 90% of their capital back into the business, even if we assume that the leverage remains 6x, you are able to get about 19-20% book value per share compounding. Now, what are high quality lenders able to do on top of this? Because high quality lenders are able to raise equity without a lot of dilution, they are further able to raise equity. On top of that, they are able to raise leverage, and therefore they are able to grow book value per share at an even faster rate. And as you've shown historically, whether it is for lenders or non-lenders, there is more than 80 to 90% sort of correlation between book value per share compounding and EPS compounding and share price compounding. So once a lender embarks on this virtuous cycle, whether it's a HDFC Bank or Kotak Bank or Bajaj Finance, which have been able to do this for a consistently long period of time, you're able to see that share price compounding for such a lender would be in the vicinity of this 19-20% number. And this we've illustrated through our previous newsletter for the Kings of Capital portfolio, where no matter which time period we take, whether it is 3 years, 5 years, or 10 years, whichever time period over the past decade or so we take, we are able to show that the lenders are able to grow at around the 20% mark. And these are companies which we've held in the KCB portfolio, which consists of 8 lenders and about 4 non-lenders. If you look at 3-year periods, FY11 to 14, 14 to 17, or 17 to 20, the average and median numbers are close to around the 20% mark. Again, if you were to take the 5-year time periods, again, that is close to the 20 to 25% mark. And same is the case with the past 10 years. Now, we need to understand that over the past 10 years, it's not that the macro situation in India was very conducive for lenders, nor was the industry credit growth close to 20%. To put this into context, the industry banking credit growth over the past 10 years was around 10.5%. Versus the 10.5% credit growth for the industry, the EPS growth for the lenders, so this is post-dilution over the past 10 years, the EPS growth for the Kings of Capital portfolio was 20%. So these are companies which are able to follow that virtuous cycle, which is shown on the previous slide, and are able to grow at 20% consistently, despite this being an industry where we have seen multiple lenders fail. We've seen multiple lenders not being able to keep up with the credit costs that come through. Now, looking at only growth, especially only say PAT growth for lenders in isolation would not make sense. That is because these are capital intensive businesses. These are businesses which can raise capital on the balance sheet. They can raise leverage on top of that. And there is enough room to deploy all of that capital in a country like India and able to grow profits. So what is important along with the EPS growth is whether they have been able to grow their EPS at 20% in a capital efficient manner or not. So if we look at, again, any cut of data, whether it's 3 years, 5 years, 7 years, or 10 years, we're able to see that the Kings of Capital portfolio has consistently had return on equity around the 20 to 25% mark. Whether it's FY11 to 14, 14 to 17, or 17 to 20. And again, this is a time period where we saw, say, the IL&FS crisis, we saw COVID, demonetization, the asset quality review, when PSU banks got hammered, when many large private sector banks also went under a lot of stress. So the simple way of looking at the KCB portfolio is, over a 3-year period, these companies are able to grow their EPS at 20-21%, along with return on equity also between the 20 to 25% mark. Now, coming to the current balance sheet position for the KCB lenders, because the lenders in the portfolio have been, because of the first wave of COVID and the second wave of COVID, they've seen challenges around asset quality. We've compared what the gross NPA numbers were before COVID, which is the Q3 FY20 number. They were around the 2% mark. Currently, this is numbers post the second wave. This is June 21 numbers. So even post the second COVID wave, the gross NPA numbers for the lenders have increased from about 2% to 3%. So it's not been an extremely high jump, which was what most people feared in April, May, June last year. Secondly, if we were to look at the provision coverage ratio, that's increased from about 50% to 70%. So the provision coverage ratio on the 1.8% number before COVID used to be around 50%. Post-COVID, post the second wave, it's gone from 50% to 70%, and that is on a much higher gross NPA number of about 3.5%. Despite the increase in gross NPAs, despite the higher COVID provisions, the tier 1 ratio for the lenders in our portfolio has increased from about 17% to 22%. So despite all of this extra provisioning, we have been able to see a increase in tier 1 ratio of about 3 to 4 percentage points. So these are lenders which are well capitalized. They have extremely strong balance sheets now. They provided for COVID provisioning. They're well provided for the COVID provisioning. And we believe they are well positioned to capitalize on the demand for credit, which is likely to come through in the coming few quarters and the coming few years. Finally, coming to the performance slide. We've been live for more than a year now. Since inception, which was on 20th July last year, we have delivered around 38% mark. Over the past year, we've delivered around 43% in terms of absolute performance.
Thanks, Tej. So, folks, I think we're now managing 600 crores in this in this strategy, and I looked at the performance numbers on Friday. So Friday, I think from inception, 20th July 2020 to 2nd September, I think it's up 40%. And Nifty Banks is up 59%. As Tej has mentioned several times before, Nifty Banks is basically 5 banks. And as those of you who have joined our webinars before know that Kings of Capital is 2/3 lenders, 1/3 savings plays, HDFC Life obviously being one of them. So we're very happy. We want that. We wanted that mix. We want that mix. We're not really that fussed about what Nifty Banks is doing. Our goal is to generate steady compounding over long periods of time. And the metrics they showed you on EPS compounding should give you comfort that the compounding will indeed be steady over long periods of time. So please fire away your questions to Tej. We'll try our best to answer as many as we can in the next 13 minutes. So Tej, Rohan, who's a KCP client, wants to know, what do you make of what's been happening in AU Small Finance Bank? Are you worried? Are you doing something about it? What's the plan? And I think there's lots of other people who are just as curious, but Rohan is a client. So let's just give him your thoughts on AU.
Yeah, sure. So at AU, let's address the 2-3 concerns or issues that most people have raised. We've also internally debated them. First is around the exits and whether there was inadequacy around disclosure of those exits. So the sequence of events has been that, first of all, the internal auditor, the head of internal audit, resigned earlier this year, and the replacements also resigned recently. Secondly, the chief risk officer has also resigned recently. Now, if we were to look at any other bank, any other NBFC, any other SFB, in terms of disclosures of AU, there is no issue. Actually, they've been more transparent. They've been disclosing more data than it's actually required. And if you were to look at, say, any other small finance bank where the chief risk officer has resigned, the disclosure happens on the day of the person leaving and not on the day of the resignation. So first of all, to put that to rest. Second, head of internal audit is not a designation that you need to disclose for. That is not required as per SEBI regulations, RBI regulations, or as per the stock exchanges. We've checked data for multiple banks or NBFCs. Third, there have been SFBs where the chief compliance officer has also resigned, and there have been no intimations made. So on the disclosure front, we believe that AU is being transparent, more transparent than required. Secondly, is there an issue around governance and why are people leaving in quick succession? That is the second question. So if you look at the function that the head of internal audit performs, first of all, he does not sign off on the balance sheet or the numbers or on the P&L. He does not sign off on asset quality. So the internal auditor does not have anything to do with asset quality or the numbers. That is the job of the statutory auditor. The statutory auditor for AU has been EY for the past 7-8 years. Recently, as per the RBI mandate, the term of EY ended because they were there for a long period of time. And as per the RBI regulations, they had to change the auditor. Now Deloitte, along with GM Kapadia, who is the current auditor of HDFC Life, whom we were currently speaking to. GM Kapadia is not only the auditor of HDFC Life, but also the joint auditor of HDFC Ergo, is the current auditor. So the statutory auditor reports on the numbers, and the statutory auditor currently of AU is Deloitte and GM Kapadia, previously by Ernst & Young. Thirdly, on the asset quality governance front, like we showed, AU is sitting on 21% plus tier 1. They have already provided for a large part of the NPAs which have come through. And they are a retail lender which have an average ticket size of about 3 to 4 lakhs on vehicle financing and 10 to 11 lakhs on small business loans. Now, for a retail lender who has an average ticket size of under 10 lakh rupees, to not recognize NPAs or to do a large scale sort of accounting naughtiness is pretty difficult. Unlike a lot of wholesale lenders, for whom it was very easy in the past to do this because they were dealing in loans which were worth hundreds of thousands of crores. AU Small Finance Bank is dealing in loans which have an average ticket size of 5 to 10 lakh rupees. So we believe, given the nature of the business, given the capital adequacy provisioning, and the historical track record of over the past 20-25 years of AU, there are definitely issues around maybe the HR front or on the cultural side, but we're not very worried around the governance or the asset quality side.
Okay, if you are interested in the subject of naughty lenders, right, and how accounting fraud is done in lenders, chapter 3 of this book is entirely on this subject, and we've given 2 detailed case studies of accounting fraud by prominent lenders. It's a really important subject to understand. So I presume if you're on this call, you are interested in the subject of how to make money from investing in good lenders. If you are interested in investing in good lenders, you need to be really, really strong in understanding accounting fraud and how it works in lenders. And if you want to build that skill set, chapter 3 of Diamonds in the Dust will be very helpful for you. We've laid out the framework. We've given worked examples of how our analysts, how the team that works under Tej in financials, how they focus on ripping out the details of a lender's accounts to check whether they're doing naughty things or not. And Tej gave you your view there on AU finance. So Tej will take Shyam Chala's question. So he's asking a sort of linked question. He's saying that, look, HDFC Bank and Kotak Bank, all very good, that Marcellus likes them and claims that there's an ocean of opportunities. But he's saying banking space does have competition. There is, after all, Axis and there's ICICI. So why do you guys keep saying that there is so much opportunity in private sector banking? And in contrast, he says, in NBFC, there's only Bajaj Finance. It's a kind of quasi-monopoly, says Shyam. So how do you think, his question is, how does it justify to have HDFC Bank and Bajaj Finance to have same weightage in the portfolio? So I guess he's asking you that in his view, Bajaj Finance should have a much higher weightage because it's a quasi-monopoly, and surely HDFC Bank has all this competition from Kotak, Axis, ICI. Why do we give them equal weight stage?
Yeah. So the way to think about it is that Bajaj Finance or HDFC Bank, even though they are under different regulatory structures, while Bajaj Finance is an NBFC, it does compete with HDFC Bank on a lot of products. They operate, both of them are in the lending industry. Both of them operate in the same industry and compete for the same set of customers. Why we think about banking and financial services and lending in particular as a large opportunity for these high quality lenders is, even today about 60-65% of India's lending is dominated by public sector players. And despite the fact that over the past 20-25 years, HDFC or Kotak have compounded at more than 20-25%, they still have market share which is in single digits or low single digits. So for example, Bajaj Finance market share is 1.5%. Kotak Bank also market share is around 2.5%. HDFC Bank market share is around 7-8%. So yes, there are multiple players who are existing in the lending space. However, if we look at them in this context, where the PSU banks have 65% market share, all private players put together have a 30-35% market share. Within that, Bajaj Finance has say 1.5% market share. HDFC Bank has only a 7-8% market share. We believe that there are not a lot of high quality private sector players who can go on and gain market share over the next 5 to 10 years. And the ones which are well run, which have shown historical evidence of the 20% consistent EPS compounding, the consistent 20% return on equity generation, we have in the Kings of Capital portfolio. On the differential between or why say HDFC Bank or Bajaj Finance are sort of not a very different weight in the portfolio. Where we believe that portfolio allocation comes into place, you need to differentiate between what the risk is and versus the risk what the returns are. So we try and balance the risk and the reward in the portfolio. We believe that definitely Bajaj Finance has its own strengths. It will be able to grow much faster than most of the portfolio companies that we hold, even Kings of Capital. Therefore, it has a high weight. However, on the other hand, the stability that HDFC Bank provides, the long history that HDFC Bank has around stable asset quality, that provides a lot of stability to the portfolio and provides a lot of downside protection, along with the 18 to 20% EPS compounding. That is where both of them have sort of a similar weight in the portfolio.
Thank you, folks. Thank you very much for joining us. Some of you again have asked, why do we use Nifty Banks as a benchmark? It's the only available benchmark. Even if you use Nifty Financials, it's basically Nifty Financials is also only lenders only. There is no benchmark for what we are doing in KCP. There isn't any benchmark in our country, which is 2/3 lenders, 1/3 non-lenders. We reckon non-lenders is a big part of the opportunity. Since the regulator obliges us to use a benchmark, we use the simplest one, Nifty Banks. But as I said, it's not particularly a big deal. Neither you nor I have to lose sleep looking at the benchmark. You look at the quality of the companies, you look at the compounding in their earnings, as Tej showed you. You look at their quality of governance, and if the business is compounding nicely, as Tej showed you, these businesses are compounding. The KCB businesses are compounding consistently over 3 years, 5 years, 10 years at 22, 23%. That's broadly the sort of compounding you should expect in the long run. That's what investing is about. It's not about looking at benchmarks and either being happy or sad. Thank you very much for your time. Thanks, Tej, and we look forward to hosting you folks again. Look forward to hosting you folks again with another speaker next month. Bye for now.